Welcome to Geojit Spotlight. The banking sector has been in the news following the crisis in the US and European banks. Though the fear of a 2008-like crisis has faded due to quick intervention of the regulators, the market is still concerned about the possibility of contagion due to the rising interest rates. Continuing its effort to tame inflation, the Fed raised rates by 25 basis points in the latest monetary policy meeting concluded yesterday. The meeting was highly relevant as the US banking system is passing through a rough phase with inflation staying at 6% in February 2023. The issue with Credit Suisse was structural in nature, while the one with US bank is systemic. The issue with the small banks in the US were that of a liquidity mismanagement and the resultant impact of sharper than expected rate hike by the Fed. The important question for investors is, how strong are the fundamentals of Indian banks? Can our bank withstand such a crisis? With stringent regulatory controls by the RBI in terms of liquidity management and capital requirement, strong credit demand in the Indian economy, and PSU recapitalization efforts by the government, Indian banks are much better positioned. The volatility in the Indian banking sector can prevail in the short term due to moderation in credit growth along with high competition among banks for share of deposits, adding pressure on margins. This is the best time for investors to implement the strategy of accumulation over the next 6 months. The current valuation of Indian banking sector is marginally below the long-term average at an 8% discount, improving the risk reward for long-term investors. Thank you.